Hey all, welcome to Share Trek. This is Raj here. And friends, it's the weekend. So we have the weekend show with Sandeep. And today, Sandeep is going to talk to us about a company called Unity Software. And Sandeep, I'm really happy to welcome you. And thanks for giving your time to help us make this show.
Hey Raj, happy to be here. Hey Share Trek friendos, feels great to see you all. Great to interact with you all, and let's get going.
Yeah. So, friends, Unity software has been picked up for a specific reason by Sandeep. He's going to talk about the reason why he picked it up. He's also going to talk about the current status of Unity software, why it caught his interest, so that he decided to pick up this company. He's also going to analyze the financials, and we will, in the process, learn a little bit about some of the financial ratios. Some of you may already know about it. Some of you may be finding it as new information. Nice to know stuff. So with that said, let's get started. Welcome back, friends. I think at this point of time, I'm going to hand over the show to Sandeep, and I'll come back in the end once Sandeep has completed his analysis. So Sandeep, take the show and run with it.
Hey everybody, thank you very much, Raj, for that wonderful introduction. Today's company, Unity Software, was actually started in Copenhagen in Denmark by three wonderful minds who started and made a game called Goo Ball back in 2005. And we don't know much about Goo Ball. We don't remember Goo Ball, but we remember Unity. Those three wonderful people realized that they were able to provide value through the tools of software development. And since then, that became their major revenue source and their major reason for their company to exist today, providing the tools for game development for others. Since then, the company has won multiple awards, and the company, although beginning in Copenhagen, is now available and exists all over the world. The reason why we're looking at Unity software today is actually because one of our wonderful subscribers and viewers requested Unity software and wanted us to take a look at it. And the stock has taken a tumble in terms of share price, especially recently, down from their highs of over $200 during 2021 to almost $30 today. And the subscriber wanted to realize what's going on with the company. Why is the company stock being punched so heavily? So if we were to compare this to a young person or an older person just being ill and unsure as to why he or she is suffering illness, suffering unwellness, you might go to a doctor. The doctor might do some blood work, take a look at your symptoms, and go through many of the reasons to try and pinpoint why there is an abnormality. And that's how I'd like to take a look at this software company, Unity. I'd like to go through some of their financials in a very special new way using financial ratios to see why Wall Street is not liking this so much. So I am going to share my screen. I have gone ahead and gone through their financial statements and many of the major points of their financial statements recently and compiled it into a few important ratios. The ones I'd like to talk about today are some of the current ratios and debt ratios. So if we were to first take a look at the cash ratio, current ratio, and quick ratio, these measure a company's ability to pay its short-term obligations. So this will be some of the debt, some of the things that are coming up in the recent history, and how well the company can handle that. And a higher ratio is much more favorable. If we were to take a look at some of the things here, their current ratios are not too bad. Their current ratio has fallen quite a bit from the prior year, 2022, but it's still positive and it's still greater than 1, which is a good thing. However, I do notice a major issue when we start looking at debt. And I'm sure most reviewers can see it as well, especially debt to equity. The company has just exploded with debt. And that can also be evident over here when we're taking a look at total debt. Their debt to equity, which is the total amount of debt versus the amount of equity, stocks, shares they have, has been ever going up every single year. And I'd like to take a look at this period between September of last year to December of last year, where debt exploded, almost doubled, pardon me, $1 billion in this 3-month period, which is insane. Why is a company facing so much debt? So if we were to go back to the example of looking at patients, if we did the blood work, we saw, hey, your blood there are some abnormalities, but it's still relatively healthy. There will be a big red lights going off when we take a look at debt. The debt just keeps going up higher and higher. Short-term debt is going up in addition to the long-term debt. And this is another ratio called days sales outstanding, which is how quickly the company can turn its product, its inventory, into cash, and how quickly they could return their sales to actual liquid cash. And this number, if it was higher, it would actually be worse. It's going down, which is a good thing. It's able to convert to cash faster. So it is able to make revenue. Its revenue is going up, as you can see from its consensus estimate. Its cash is going up. It has cash flow positive, but its debt is going up greater and greater. And why is that? Why is the debt going up higher and higher? We can go further into their balance sheets, into their statements to see why. And as I was doing that, I noticed that the company is spending in every single area. They're spending more on their research and development. They're spending more on their marketing and their sales. The company's spending much more. And if we were to think about this kind of like a financial advisor, where someone will come in and say, hey, I have a lot of debt, a lot of financial issues. Can you help me? A lot of financial advisors take a look at, there's 2 ways to solve many debt issues. You can either increase your income, or you could decrease your debt. Right now, it looks to me like Unity Software is trying to remedy that issue by increasing their income. But we'd still like to dig a little bit deeper. And another thing I took a look at while looking at their financial statements is the company's bond rating. A lot of the income doesn't actually come, a lot of income from a lot of companies doesn't actually come from equity. It comes from bonds. And their bond rating is BBB rating, which is very, very low. Their interest expense is very, very high. The company is, although growing, although able to go from a 50% revenue growth to a 80% revenue growth, although their gross profit is able to go from 65 to 70% in just 3 quarters, the company's interest expense is going up even higher. Their gross margin is going up steadily, but their interest is going up even greater. That kind of leads me to almost play the forensics and kind of think that this company is unable to borrow at a cheap rate. The company is borrowing at high rates. And another thing that I'd like to take a look at here, which is a thing that Wall Street looks at, is how efficient is the company's employees. Another thing I noticed is the company is hiring a lot of employees, which it's not for me to say if that's a good or bad thing. I think it's great. More employees can mean more ideas, can mean better for the economy, more people able to pay the bills, just better for the GDP in general. But Wall Street takes a look at this Unity and compares it to some of its peers. If you take a look at Tencent, has over 100,000 employees, makes $150 billion in revenue. If we were to take a look at the revenue per employee, it's actually pretty high, close to 1.4. EA and Activision, their ratios are in the around the same range, 0.16, 0.17. However, Unity, they don't make as much revenue, but they have quite a bit of employees. The employee revenue per the amount of revenue they make is the lowest. And this is something that Wall Street likes to look at. And this is something that Wall Street notices and sees a problem with. And I think that's probably why Wall Street and other bond rating companies have lowered the quality of their bonds. So if I were to use the example of someone trying to borrow for a car loan or a different loan, we take a look at the credit rating, we take a look at, are there any outstanding debts? And because of that, you might borrow at a different rate. Someone with a high, nice credit rating, like maybe Raj or maybe some of our viewers, you borrow at a more favorable rate. But someone with a lot of debt will borrow at a much, much greater rate. 5% versus borrowing at 10% makes a very large difference. And I think, especially from their interest expense ratio, Unity is experiencing a debt problem. And they're trying to solve this debt problem by not trying to decrease their debt, but increase their revenue. Not by trying to borrow less, but trying to grow more. And I'm not saying that that's a good thing or a bad thing. I'm just saying this is what it looks like they're doing. And I'd also like to bring up something that also I found really, really intriguing. Unity, they have been in the news recently because they changed their revenue model to a per click, per download model, which Wall Street loved. And as you can see over here on September 12th, when that was announced, their stock price went up to over $40. That came with a lot of backlash. People did not like it, especially the developers. And since then, the company has backtracked, and the backlash has resulted in a significant decline to over here in the 30s. If we were to map Unity software price right now at about $31, its expected end of the year EPS, and since it's a money losing company, its EPS and PE will be negative. But with great growth rate, we can see that their PEG ratio is improving, but just, I don't know if the company can sustain the current path. But I'd like to bring Raj back and get his ideas, what he thinks Unity is. But yeah, I hope that answers our viewers' question. Raj?
Yeah, so I don't know. I saw your presentation on Unity, and I thought that their biggest problem is the huge jump in debt between, I think, Q2 2022 and the next quarter. There was a huge jump. The second thing that caught my attention was the low productivity. Of course, Tencent is a different category altogether because they have cheaper labor, I suppose. If I'm not mistaken, they are based off China, right?
Correct.
Yeah. So they have a cheaper labor, whereas California-based companies pay higher taxes and they have higher wages for their employees. So those aspects could work into them. So the comparison between Unity and EA and the other US game companies, that was more apt. And even there, they did not score very well. So that's another red flag. And as you mentioned, instead of generally when companies are caught in a situation where they have a very bad debt equity, either they will raise more equity and continue with their business, or they would try to cut costs strategically so that they can generate more cash and pay back more of their debts, or they may issue some other kind of rights or something, sell some rights or some patents and get some cash. As you said, this company is taking a big risk, in my opinion, because they are expecting that if they spend more on R&D, spend more on marketing, and somehow they can push through and get more revenue, and using that, they will pay off their debts. So that's a very risky gambit, I suppose. But I haven't seen this company too much. I mean, I have been off late looking more at genomics and philosophical questions around pricing and all that stuff. So this was very interesting, Sandeep. I think you did a very detailed analysis out there. And I guess this segment is just right. I think when I edit this and put it all together, it should be around 20 minutes, or if we are done better than 25, it would be great. So thanks a lot, Sandeep. It was a nice job.
Thank you very much, Raj. Thank you very much, Share Trek Universe. And until we meet again.
Yeah, thanks, Sandeep. And friends, I think we're going to keep on improving this segment. And Sandeep has been working very hard. It's been almost 4 weeks since we started this new video. And it has not been easy for Sandeep either, because he's not a regular content creator. He's just trying to help out ShareTrek. And I really commend him for all his efforts. And with every subsequent video, I think we are getting better. And the next one will be even better. But if you have any suggestion of any particular company or any particular query you have, please send it across. And if we can, we will do it in this segment out here. And friends, we are coming close to 5,000 subscribers. So if you're not yet subscribed, please subscribe and take us closer to 5,000. And if you're already subscribed and have been watching our videos for a while, we're coming to the end of the month. So please take the next step, press the join button and become a member, and help grow this channel. Thanks and have a great day. Bye for now.